Hi, welcome to Main Street Macro. I'm Neela Richardson. And I was just recalling the first time that I received my keys as a new homeowner. I remember the scene perfectly. We were all in the room together, my husband, myself, my realtor, and the seller, his husband, his realtor. And I remember that crucial moment when he passed the keys to me. Well, this moment is becoming more and more out of reach for a lot of home buyers. It's a really challenging market to be a home buyer. We're seeing something that we haven't seen before in housing market history. We haven't seen an incident where house prices continue to climb, even though interest rates are soaring. In fact, they're at a 20-year high. But as challenging as today's market is for home buyers, there are some limitations too for homeowners. Here are three reasons why. One, the effect of rate lock. The median mortgage rate for most homeowners is about 3%, but mortgage rates now are much higher than that. Over 7%. That means for a lot of homeowners, they can't afford to do a lot of things with their house that they may like to do. One of those things may be to downsize, maybe upsize, move to a different neighborhood or a different location. They may not love their house, but they do have a deep affection for the very low interest rates that they were able to capture when mortgage rates were very, very low before the Fed started their hiking cycle to tame inflation. Now, the second reason why this interesting housing market that we're in could be limiting for homeowners is the idea of home equity. You see, the great thing about being a homeowner with this who was able to capture a very low interest rate is that you've seen a lot of appreciation in your house price. Now, historically, what homeowners have done with that house price appreciation, sometimes they cash it out. They do something called a cash out refi, or they get a loan based on the equity of that home. And they use those proceeds to do all kinds of things. Maybe it's to renovate the house, put a second addition on, that mother-in-law suite that we all want, or it could be to use that money to pay down higher interest debt like credit cards. And we know that student loan debt and student loans are starting to restart in terms of that first payment. And importantly for Main Street, sometimes they use that home equity to either start new businesses or expand business operations. But each of these opportunities are limited if you have to refi at a higher rate. And so that equity stays locked under lock and key, unfortunately, for many homeowners because it's just too challenging to tap that money out. Now, the third reason that we should care about homeowners goes right back to the job market. Because if it's harder to sell your house or because it's more expensive to buy another one, it might limit your preference in terms of leaving one location to go to another based on a job. And so that mobility in terms of the workforce, even though a lot of us can work from home part of the time, the ability to move to where the great job is has been a cornerstone of a very low dynamic labor market in the United States. That cornerstone may be limited by the lack of affordability in the housing market. Well, thanks for watching the Main Street Macro. For more information on housing market and how housing affects jobs, and for that very important national employment report that we'll be issuing on Wednesday, please check out adpri.org.